In today's video, I want to discuss what it takes to develop a successful long-term trading strategy. Folks, there are literally thousands of ways to make money in the market. And right from the start, let me tell you that making money in the market has nothing to do with how often you produce a winning trade. You can have a strategy that wins 95% of the time and still consistently loses money over the long term. Conversely, I've seen strategies that lose 9 times out of 10 and yet produce huge gains uh, over the long term. This is how most newsletters sell subscriptions, though. They tout exceptionally high winning percentages. And then most clueless retail traders assume this means the system is extremely profitable when in fact it's usually the opposite. Granted, most services greatly exaggerate their winning percentage, but this kind of strategy generally produces a lot of very small winning trades that ultimately get overwhelmed by a few big losers. On the other hand, I've seen strategies that lose many times in a row and then catch a huge trending move, ultimately producing excellent long-term sustainable gains. However, you're never going to sell newsletter subscriptions by telling people they're going to lose 9 times out of 10. The real secret to making money in the market is to find a successful strategy that produces consistent gains over time and then accept that from time to time the market is going to break your system. Let's face it, no system ever devised ever works 100% of the time. The market eventually breaks every strategy, no matter how good it is. The key to making long-term gains is to be able to recognize quickly when the market environment has changed and adapt your strategy as quickly as possible to the new conditions. Now, let me show you a couple of examples. As gold completed its bear market and started the baby bull rally, I was one of the very few people that actually did catch this move in real time. And while most newsletter writers will tell you that they caught the exact bottom, the real truth is that most people missed this entire first leg up in the baby bull in real time and didn't get on board until well into March and April. So we made some incredible gains during the baby bull rally. However, I held on to our long positions just a little bit too long up here. I was expecting gold to make a marginally higher high. This is usually how gold tops. And when it didn't, we got caught in this intermediate correction right here after or right ahead of the elections. That's a little bit hard to see, but there was very stiff resistance right here at about 1270. That took gold a lot of time to break through. I told subscribers at the time that if this resistance level was given back, it would probably not be a good sign, and it would be best to just accept the loss and move on. Some people listened to me and subsequently avoided the correction after the elections. Many other people were not able to make themselves take the loss and ended up riding this correction all the way down to the bottom in December. This is the spot at which many people became frustrated. A lot of subscribers canceled their subscription. And of course, this was absolutely the single worst thing they could have done. Unlike the average emotional retail trader, I understand that corrections are opportunities. And the deeper a correction is, the greater or the further the rubber band stretches, the greater the opportunity. At the height of the baby bull rally, we were up almost 200%. Like I said, we got caught. We held a little too long. We ended up giving back a huge chunk of our baby bull profits to the point at which we were only up about 50%. However, over the next year and a half, the SMT metal portfolio went on to gain almost 400%, actually a little over 400% at this point right here. So you can see it was a colossal mistake to get frustrated and give up down here, a colossal mistake to cancel your subscription right before we started a huge run higher in the metal portfolio. But this is just how most people behave. They are ruled by their emotions. They sell when they should be buying, and they buy when they should be selling. You know, human nature never changes, and this is just the way most people behave. Now let me show you a second example. When the stock market correction began back in October, we entered long trades way too early. I was not expecting stocks to move down into a 4-year cycle low this early in the cycle. In theory, it really shouldn't. We shouldn't have gotten that bottom until 2020, but occasionally a cycle will shrink or stretch, and I just was not expecting this 4-year cycle low to shrink and occur this early in the 4-year cycle. And I was certainly not expecting a 5th daily cycle embedded within the intermediate cycle. I don't think there has ever been 5 daily cycles in an intermediate cycle, so it's just not something that I had any historical reference. The market just threw me a curveball that I was not expecting. We ended up taking a large drawdown. Fortunately, though, we did manage to exit and avoid this final bloodbath phase right here, which would have been excruciatingly painful if we had held through this. At this point, I recognized that the market environment had changed. We were getting things happening that had never happened before, and it was, at least temporarily breaking my system. So we needed to adapt and develop a strategy to recover our loss. Now, as I've noted in several previous videos, the CRB is due for a 3-year cycle low. That meant there should be a very profitable opportunity brewing in the energy market. Now, to recover our loss in stocks, we would need the stock market to rally almost back to new highs. On the other hand, oil being much more volatile than the stock market, we only needed roughly a 15% move in oil to completely recover our losses. So instead of sticking with the stock market, we shifted gears, adapted our trading strategy, and looked to a different market to try and develop a strategy to recover. We managed to get into oil pretty close to the bottom right here. And now over the last 3 weeks, we've completely recovered our loss from the too early or the premature entry into a TQQQ trade that produced that big drawdown. We've completely recovered those losses, and the portfolio is back in the green over the last 55 weeks. And I don't think that this is the end of the rally in oil by any means. If this was a 3-year cycle low right here, then we probably have about 2 to 2.5 years yet in this rally before oil is due to top and then produce another one of these kind of moves. So I think we are setting in a good position and potentially in position to produce the kind of massive return that we produced after the election sell-off, the opportunity in the gold market after the 2016 election that so many people missed because they got frustrated and gave up too early. The system wasn't broke, it just quit working temporarily, but it didn't mean that we couldn't adapt to the changing conditions and not recover and make money, which we did. Huge money over the next 2 years in the metals market, even though we took a big drawdown by hanging on to our long positions after the baby bull had already topped. So over the last 3 years, the metal portfolio has returned almost 400%, and the stock portfolio almost 200%. You're going to be pretty hard pressed to find many hedge funds that have this kind of return over an extended multi-year period. And yet during this time, we had two really bad trades where the market environment changed and caught me off guard. That didn't mean that my system was broke. It just meant that the market environment had changed and we needed to recognize it and adapt to it. As you can see, that's exactly what we did. And in both cases, the losses were quickly recovered and the portfolios went on to make excellent long-term sustainable gains. So the secret of successful investing has nothing to do with how often you produce a winning trade. And I would even go so far as to suggest that when a newsletter touts these amazing 90% winning percentages, you can apply the, if it sounds too good to be true, then it is too good to be true rationale, and you pretty much just figure that they're feeding you a bunch of baloney. Just accept that every system is going to break from time to time. There's no way to avoid it. And the key to successful investing is to be able to recognize quickly when your system is breaking down and be flexible enough to adapt and modify your system when needed, so you can recover from losing trades and continue making long-term sustainable gains.